Howdy folks, your old pal Joe D here. Thanks for joining me in another video. Today I'm going to talk a little bit about HELOCs or home equity lines of credit versus home equity loans versus a quote-unquote refi. So if you're interested in learning about the differences, this is the video for you. Quick note though, if you like my content, please like and or subscribe. Definitely helps me out. Okay, so here we go. So let's start with HELOC. So home equity line of credit. The home equity in the home equity line of credit or home equity loan is the remaining equity in your home. So the value of your home less the remaining balance on your first mortgage. The difference there is the equity in your home, or the amount of value of your home that isn't encumbered by the first loan. So you can take another loan using that remaining equity as collateral. Now, you might have ever heard the phrase every time, oh, I had to take out a second on the house. Well, that refers to a second loan, and that second loan is utilizing the remaining equity or the home equity as the collateral. Now, a HELOAN, as sometimes it's referred to, as opposed to a HELOC, is really more what a second is. And the difference between a HELOAN and a HELOC is that the loan is much like your first mortgage. It's an installment loan, meaning they give you how much you decide to take, or they're willing to give you. They give you that whole amount up front. Maybe you're going to do something with it, like renovations or who knows. And you have a fixed interest rate and a fixed payment on that loan for a fixed period of time. Oftentimes it's a 20-year or 30-year loan, and the interest rate won't change, and you pay the same amount every month, just like your first mortgage, okay? The HELOC is different. It's utilizing the equity as collateral for the loan, but it's a line of credit. It works more like a credit card does. So I like HELOCs if you're not going to go do something with the money, but you want to have access to money for whatever reason. In my case, like I kind of look at it as my emergency fund. I don't like to have an emergency fund in cash. I want to have that invested. But if it's invested, I might not be able to sell it quickly for whatever reason. So I use my home equity line of credit as a cushion, money I can access quickly and use for any purpose in an emergency, say, where I don't have to go sell the investments right away. I have some time, to kind of figure out what I want to do. But the beauty of the home equity line of credit is that I don't have the money out when I don't need it, so I'm not making a payment on it or paying interest on it. With the home equity loan, you take the money up front, you're paying interest until the loan's paid off. The home equity line of credit can be used, drawn on, money used, paid off, and the line still stays available to you even though you haven't drawn on it or you've paid it back in full. It stays available for future use. Usually with home equity line of credits, the payment you make is usually interest only. So the payment, in its total sum is smaller than a principal and interest payment. The hitch there is if you hold money out on the line of credit for a long time, you're never paying down your principal balance unless you make a principal payment. But the interest only payment is the most flexible, easiest, and least out-of-pocket payment at the time. Now, some HELOCs do a principal and interest payment instead of a interest only. Like I have a HELOC and I have some money on it now, and once I take a draw, they figure out a principal and interest payment to charge me every month. But if I go pay it off, that payment goes away. Now, how these differ from a quote-unquote refi is that usually when you refi, what you're doing is you're not taking a loan just on the using the available credit as your collateral. You're saying, hey, I want to get an entirely new loan for my house. I'm going to pay off my existing loan and start fresh with a new loan. And when you do that, you might be doing a cash out refi as well. So you might be tapping the additional equity available in your house, but you're doing it as one brand new loan. So you're going to pay off the original loan and you're going to get some extra money or cash out, that is essentially collateralized by the equity in your home beyond the first loan that you're refining. So there's a distinction there. With the HE loan, you end up with two loans: the original loan you had, and then a new loan collateralized by the equity. On a refi, you will have one new loan, but you'll get money out. Now, why you would choose one over the other probably depends most on the interest rate you get. If you have a great interest rate in your first mortgage and rates today are higher, you probably don't want to refi the whole thing. Maybe you can just get a second and have one loan at, say, 4% and the second loan at 6%. That's probably one of the biggest reasons where you wouldn't do an entire refi. Now, with a HELOC, the interest is not fixed, it's variable. It's usually prime or prime plus 1 or prime plus 2. It kind of depends on what your loan to value you go up to and what your credit score is on what your pricing is. But the interest will adjust every month based on prime. So that is a little bit of a downside of the HELOC, but because you're not paying interest on the money, and if you don't need it, you just have the money available to you as available credit, but you're not paying interest on it if you're not using it. On the whole, you're going to save in interest, so it's favorable to go with the HELOC and with a higher or variable rate. So the other thing I'll mention about the HELOCs or HE loans is that the amount of the remaining equity you can use depends on the bank. Some banks will allow up to 100% of equity usage. So if your first loan, is utilizing 70% of your home's equity as collateral, your HELOC might be able to use the remaining 30. So if your home is worth $100,000, your first loan is collateralized by $70,000, and the HELOC is collateralized by the remaining 30, and in your HELOC available amount would be $30,000. That's very high end. You're going to find anywhere you can comfortably get a HELOC up to 85% loan to value. It gets harder as you go up to try to get 100% loan to value, and you'll pay more in fees and in interest for utilizing that maximum amount of equity, but it is available to you. So I think everybody, if you're going to be in your house for a while and you like your first mortgage and it's a good rate, everybody should get a HELOC, because oftentimes you can get them with low or no closing costs. Credit unions are very good about this, and you don't have to draw on them, but they're there for you when you need them. And you don't want to go get one if you're having a tough time financially and your application isn't good. You want to get the HELOC when times are good and you don't need the money. Get the HELOC set up. That way, if you run into tough times or you lose your job or whatever, you have an emergency, it's already there for you. It's really hard to tap your equity when you're in a financial hardship situation. You want to tap it and have it available to you when you're not in that situation. And that's why a HELOC is great, because you can have access to the equity without actually having to have it be drawn out and be paying interest on it. So there you go. Go get a home equity line of credit. Talk to you later.